Howdy, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Thursday, May 22nd, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been performing, you need to be a client of 42 Macro. So today's key macro question: how much is too much paradigm C? Our answer: as predicted, the One Big Beautiful Bill Act passed a narrow vote in the House and is headed to the Senate, where we anticipate it will get even bigger and more beautiful from the perspective of risk assets that are still concerned about the impact of the tariff shock upon the US and global economies. Incremental fiscal largesse makes the bill increasingly ugly from the perspective of bond investors. Unfortunately, there is no end to bipartisan fiscal largesse in sight. This is a key reason why we believe the Trump administration is likely to replace Jay Powell with the Fed chair in waiting that is amenable to our 3% inflation target. We are not smart enough to tell you exactly what level on the 10-year nominal treasury yield will trigger a 10% correction in stocks. We are smart enough to reiterate that more fiscal largesse is not a durable bearish catalyst for equities because it represents a positive shock to growth relative to diminished consensus expectations that are still likely overpricing the odds of a recession. For our May 3rd leadoff morning note, as we signaled a few weeks ago, the administration has clearly pivoted to promoting the pro-growth, pro-markets aspects of the Trump 2.0 agenda, essentially truncating the detox period Treasury Secretary Bessent promised back in February. So where are the economy and asset markets headed? Early evidence suggests Paradigm C, which features all the fiscal and monetary largesse of Paradigm A, plus a collection of supply-side sweeteners that are all favorable for Wall Street. Paradigm C represents a much risk for the bond market than it is for the stock market and other risk assets. While the U-shaped economy is still ahead of us, bears would be remiss to assume that risk assets can't look through a transitory slowdown in growth and continue their V-shaped recovery. That is the modal outcome if, in fact, Paradigm C is the ultimate destination. While it is too early to definitively conclude if Paradigm C is the destination, it is safe to assume the increased probability of Paradigm C is why both Kiss and Dr. Mo have gotten increasingly invested in recent weeks. And again, that was from our May 3rd leadoff morning note. And then per our May 17th Around the Horn webcast, while there will be bumps and bruises to price in along the way as slowing growth flatters consensus recession fears and congressional brinksmanship threatens the One Big Beautiful Bill, we view both outcomes as scarecrows to be faded. Let me say that again. While there will be bumps and bruises to price in along the way as slowing growth flatters consensus recession fears and congressional brinksmanship threatens the One Big Beautiful Bill, we view both outcomes as scarecrows to be faded. The acceleration in global liquidity is mitigating and potentially truncating the global debt refinancing air pocket. The U.S. economy is proving more resilient than consensus believes it is, and inflation is no longer likely to surprise to the upside over the medium term. As such, we find it difficult to envision a scenario where risk assets are not materially higher by year end. Transitioning to our 42 macro dashboard, as always, a wrap up the question from our community. This one is regarding our call, our 3% inflation target call, and its impact on the bond market. So let me read the question here. It says, I'm a retail investor, and I'm having fun leveling up since I joined 42 macro earlier this year. I understand most of the 5 benefits of a 3% inflation target, but I'm having difficulty with number 4, which is a higher inflation target would allow real interest rates to decline across the curve by causing long-term pricing in the TIPS break-even and inflation swap rate markets to adjust higher from current levels around 2.5 to 3%. The point was also addressed in the May 17th Around the Horn. While there can be many inputs in the yields, and there are, what are the chances that the bond market would raise yields on the long end of the curve after a Fed rate cut, just like it did in the fall of 2024? When the nominal yield adjusts higher, commensurate with the higher inflation target, neutralizing any decline in real interest rates. Thank you, DD, for all the hard work you do. I appreciate you. This year has been much easier to navigate thanks to Kiss and Dr. Mo. Much easier than trying to understand the bond market and yield curves for sure. All the best. So thanks for the kind compliment. Really appreciate that. So getting to this question, phenomenal question. If you guys are not familiar with our view that the Trump administration, in our view, they are likely to, at the bare minimum, consider a Fed chair candidate, a Fed chair in waiting candidate that is amenable to our long-held belief that the Federal Reserve must and likely will revise its inflation target higher before this foreturning is over. Otherwise, they're going to be responsible for a significant accident in the Treasury bond market that has been facing a geopolitically driven supply-demand imbalance since at least 2022, perhaps early as 2020. That's what our investing during a foreturning regime analysis, that's one of the key conclusions of our investing doing a forward turning regime analysis. There's so much stuff going on that is consistent with historical forward turning episodes from a fiscal policy, economics, and geopolitical standpoint that are all negative. They're negative demand shocks for treasuries. At the same time, we're having this positive supply shock from populist fiscal policy domestically. So that as long as that persists, you're going to have a Federal Reserve that gets dragged kicking and screaming to support the Treasury bond market. That's our core belief. And so it's Furman's principle. What's the easiest way to fix that? It's just revising the Fed's inflation target. The hardest way to fix that would be obviously fiscal austerity. But again, fiscal austerity seems like a very low likelihood given the starting point of an increasingly K-shaped economy and a very pissed off voting base that it's tired of seeing millionaires and billionaires get more millions and more billions while the average common man gets stuck with the prices at the grocery store and at the pump and for a variety of other services that they consume. So this isn't going away in our opinion. So just getting back into the question, this populist fiscal demand for populism from the U.S. voting base is not going away. This is why we said in the last fall, Kamala Harris versus Donald Trump is on the ticket. But what's missing from this discussion or at the time was the fact that both candidates supported populist fiscal policy. And increasingly going forward, both candidates will support populist fiscal policy, especially if we're right on paradigm C, not only being supportive of the continuation of the K-shaped U.S. economy that was featured in Biden's administration, it's actually going to make the K bigger, in our opinion, which is a net positive for risk assets in Wall Street, but not necessarily a net positive for Main Street on a relative basis. So getting back into the question, so I'll just read the first one. While there can be many inputs in the yields, what are the chances that the bond market would raise yields on the long end of the curve after a Fed cut, just like it did in the fall of 2024? So there's definitely a risk of that. Obviously, if the Federal Reserve, and I had a great discussion with Nick Tiramos at the Wall Street Journal on Twitter yesterday, so check that out if you guys haven't reviewed that. He and I had a good back and forth on this. But just in terms of the potentiality for the bond market to sell off if the Fed has a positive revision to its inflation target, Nick essentially said, hey, if you positively revise your inflation target after 4 years, while you're still struggling to get to your inflation target, it sends a really negative message to the bond market that you could potentially revise it again in the future and have it continue to go up. I take a different approach to that, in my opinion. I think having a positive revision to the inflation target would actually institute more credibility into the bond market. Right now, the bond market's struggling with the Federal Reserve that is unwilling to do what it takes to achieve durable 2% inflation. Again, our secular inflation model since January of 2022 has persistently signaled that the equilibrium core PCE inflation rate in the US economy is somewhere in the high 2s or low 3s, which is greater than. And so in order for the Federal Reserve to have persistent, durable 2% inflation, they're going to have to run persistently restrictive monetary policy that depresses growth and crowds out consumers and businesses on the most small part of the K. That's what they've been doing, by the way. But certainly policies is not as tighter than it otherwise would be if they had a 3% inflation target. And so I believe if they revise their target to 3% and actually demonstrate it to the bond market, they can actually achieve it. It might actually calm things down a bit. Right now, the bond market is struggling with the Federal Reserve that is very clearly sending a signal that it is not willing to do what it takes to have 2% inflation. The bond market knows what the equilibrium inflation rate is in the economy, or at least it's closer to understanding that than the Federal Reserve if you look at pricing in the break-even market and pricing in the inflation swaps rate market. And so at the end of the day, we think a positive revision would allow the Fed to say, hey, we're actually achieving our inflation target. We're going to keep it here. We're going to be serious about 3% inflation because we very clearly weren't serious about 2% inflation with 4 consecutive years and counting of positive surprises from that perspective, or positive surprises relative to their target. So getting back into the question, wouldn't the nominal yield adjust higher commensurate with the higher inflation target, neutralizing any decline in real interest rates? Yes, perhaps that is potentially, but again, real interest rates matter more when you're talking about capitalizing assets and the growth of the economy in terms of its impact on the growth of the economy. So if you have the same level of yield, but you actually had the same level of nominal yield, but a lower real interest rates because you transferred, 50 basis points from real to nominal, that is a better outcome for the economy and the asset markets than it is if you just had a very elevated real interest rates. All you're doing is transferring growth points from growth to inflation. That's exactly what we've seen, by the way, with consensus GDP expectations. We have this metric here, 42 macro, called the consensus short-run potential GDP expectation and the consensus short-run potential growth expectation. And so this is Wall Street's assessment of the, kind of how much growth does the economy generate on a trend type basis, on a forward looking trend type basis. It's the blend of the current year growth expectation and the next year growth expectation, and a blend of the current year inflation expectation and a blend of the next year inflation expectation. And right now, if you look at those expectations, the consensus short run potential growth expectation went down 80 basis points from a high of 2.2% in February to 1.2% currently. So consensus just generally thinks over the next current year and next year, U.S. economy is going to grow somewhere around 1.4% on a trend basis, minus 80 basis points from the high. If you look at the consensus short run potential inflation expectations, they actually went up 80 basis points from the low that we achieved, that we saw in September 2024, from 2.2% to 3%. So we just transferred 80 basis points from the consensus real growth expectation, 80 bit to the, and given that to the consensus inflation expectation. So consensus still thinks nominal GDP is going to be somewhere around 4.5%. It's just that 80 basis points went from real to nominal. And you can have that same exact transition take place in the context of the bond market, in the terms of, you have the same level of nominal yield, but you're transferring more to inflation pricing and taking some out of real. Now, I still think real yields could potentially be biased to the upside, because ultimately what all this means is you're going to have a Federal Reserve that is more proactive about supporting growth. A 3% inflation target would allow them to lower the interest rates and take down the floor policy rate, which is the lowest rate on the OIS curve about 2 to 5 years, in terms of where the market thinks the lowest level of the federal funds rate will get on a go forward basis. If you had a positive revision of the inflation target of 2 to 3%, it's going to take that floor down, because ultimately the market's going to say the Fed can cut more if it's already achieving its 3% inflation target. In fact, it'll be a negative surprise relative to the 3% inflation target, the current level of core PC inflation. So just be aware of that. And at the same time, if there was, and another thing the 3% inflation target would allow the Federal Reserve to do to support the bond market and cap yields is yield curve control. Right now, you can't do open-ended yield curve control with a 2% inflation target. But if you said you had a 3% inflation target and bond yields are starting to rise as a function of their own reaction function to certain terms of supporting the economy, they can actually put a cap on that at some point. And I think a yield curve control cap will be required at some point in this fourth turning. We saw it in the last. I'm sure we've seen evidence of that. We didn't have the Fed back then, but I'm sure we saw, we had JP Morgan, limiting the U.S. government money back in the early, back in the turn of the century. So, there's always going to be policy shocks that try to mitigate economic and financial market volatility. And what we're trying to do, we're trying to identify which policy shock is the path of least resistance to helping the Trump administration engineer their desire for a golden age for America again. If you want to have a uncrowding out of consumers and businesses on the bottom part of the K, several things must take place. And the positive revision of the Fed's inflation target, which again doesn't cause 3% inflation. Some people are myopically thinking that I say that, and oh my God, the Fed's going to start creating 3% inflation. No, the economy has an equilibrium 3% inflation rate. The Federal Reserve is just not aware of that and is guiding monetary policy in a level that is trying to get to 2%. Just acknowledging that populist economics equals more inflation, that the rest of the world girding up for war, China building up for war, Europe now getting ready for war, the US getting ready for war with these Section 232 tariffs. This is a demand for global capital that is going to keep upward pressure on the long end of the curve, not just this year, but over the long term. And that's all part of this geopolitically driven supply demand imbalance that we identified in the Treasury market a few years ago, or a couple years ago, in the summer of 2023, in our investing during a forward turning regime analysis, which, by the way, check out our dashboard here. You can go check it out. Everything you need to learn about the forward turning as it relates to what you should be doing as an investor is here in our investing during a forward turning regime section. You can watch our latest videos on that here, and then even search and ask questions. And if always, you can contribute to our community chat. It's a wonderful community, thousands of really thoughtful investors around the world. We got hedge fund portfolio managers, mutual fund CIOs, pension fund CIOs, interacting with regular retail investors, RAs around the country and around the world. I'm really fascinated and really grateful for the collaboration that we continue to have in our community. We're making each other smarter faster than the people on Twitter are making themselves smarter. A lot of times I argue a lot of the folks on Twitter are making themselves dumber too. So that is what it is. We'll wrap it up there. Darius still here presenting our macro minute for was it Wednesday or Thursday, May 22nd, 2025. Everyone have a wonderful day out there. Best of luck. We'll catch back here tomorrow. And actually, I'll be on our friend Charles Payne's show today at 2 p.m. So shortly after the 2 p.m. hour. So come check me out on Fox Business to support our friend Charles Payne. Cheers.